Okay. Yesterday, we left off at this topic. We said that we will not complete the whole time because one of the students, probably Kelvin, you logged out?
No, it was me.
It was
Sorry?
you. Okay, okay.
Yeah.
So we will continue from this point on. This is still the same chapter we are going through, and the topic is C and project benefits and value, what we are going to talk about. Now, this is again a very important topic, and naturally, until and unless you realize this, you won't be able to really understand the concept of strategic alignment. Uh, there was one thing we talked about, that was the vision, mission, and goals and objectives of the organization. You see, that is very important. That is most important. But at the same time, we also have to look at if there is any business value being generated out of this project. Although this project may be strategically aligned with the organizational goals and objectives, that might be true. But at the same time, if this project is not generating enough value for the organization, I mean in tangible or intangible terms, then probably this is not a very good exercise. Strategic alignment apart, but value is not being generated. Although strategic alignment is more important than business value, but it may become infeasible if business value is not sufficient. Anyways, how do we assess the business value? How do we know that this project is generating enough value? So rather than looking at the value being generated out of the project, we must first look at what is the business value of our organization. How do you assess that? How do you know what is the business value of our organization at this point in time?
Um, Financial value?
Which value?
The financial value, because this is the most obvious form of business value.
Okay, very good, very good. But
And then,
that would be the tangible. That would be
yeah,
tangible. The assets of the organization, the accounts of the organization, the current financial value of the organization is naturally the current business value of your organization, or I can say the current business worth of the organization.
and
But
then
what
the
about,
customer,
yes,
sorry,
please?
and the customer value and strategic value.
Yes, there are many intangibles. You have you have run this company for quite some time, and during that period, you have established various other values also, which are not tangible, which are not in can be described easily in financial terms. So such values like goodwill you have earned, the brand value, the logo you have created and how popular that
Mhm.
logo is, and things like that, which may not be directly translatable into financial terms, but this is also the value addition to your business value, and that when you try to sell your business off, then all of these intangibles also get accounted for. So it is not just the tangible value or the financial value of your business right now, but it has got a lot of intangibles which add up to it, right? And maybe that makes your total business value uh, twice as much, right? Now, my point is, yes, of course, even if there is an intangible benefit, I have somehow to assess it in some kind of financial terms, in a long-term benefit or something like that, as if I can ascertain the business value of my organization at this point in time. So that is, I am just looking at the concept of business value on a top-down model, that how much your organization is is currently total worth. Okay, tell me, if you know your organization's business value or the total current worth of your organization is $5 million, and you are doing a project in this organization, your project is very much aligned with the strategies of the organization. This project runs for 2 years, and at the end of 2 years, can you tell me how much have you added to the value of the organization, the business value of the organization? How much have you added? What value addition have you done to the business value during these 2 years? What is your estimate? Right?
Uh,
Can you do that?
we have started with the 5 million.
5 million is your total company worth, right?
Okay.
And you're doing this project, and this is go on for 2 years. Do you expect that the business value of the organization due to your project will increase in these 2 years?
Mm.
That only can be assessed by the risk assessment, isn't it?
Well, risk is a natural part of your planning, and there are positives and negatives in it. There are opportunities and threats in it. So, taking all that into account, what do you plan the value you are going to be delivering at the end of the project? How much value will have been added to the total worth of the organization? Total worth of the organization is $5 million. And this project, will it add anything to the worth of the organization?
Uh, we can say that all the assets, liabilities, and the cash flows,
Mm-hmm.
the 5 million is the asset, or the value of the company,
No,
right?
not the campaign. I'm saying
Okay.
5 million is the total worth of your organization at this point in time. If you
Mm-hmm.
try to sell your business right now, it will get you $5 million. Somebody can buy your business off, right?
Mm-hmm.
That is the total worth of your organization. That is the current business value. And
Mm-hmm.
you have just started a project. Do you think that this project is going to add any value to your organizational worth, to the business value of the overall organization? What is the addition your project is going to bring to that? Maybe that the expectation is $1 million addition, right? So there must
Mm-hmm.
be some business value addition. Your project must be delivering some kind of value, right? If
Mm-hmm.
your if your business value is going to remain the same after 2 years, what it is today, then there is no addition to the value of the business. Then the question arises, no matter even if your project was strategically aligned with the strategic objectives of the organization, but you have uh, added zero value to the organization, which is objectionable. So, although strategic alignment was very important and that was the primary reason why you're doing this project, but at the same time, there is a secondary reason that your project is not adding any value to the organization. Should we continue doing it, or should we go on to another more profitable initiative? Does this question not arise?
Sometimes I had seen in the projects like, where you are not, making any profit is
Mhm.
something that is one of the intangible, like the reputation, It's something that,
Mhm.
yeah, we need to complete the work, no matter
Mhm.
even if we are losing, but it's a matter of reputation, That's something that sometimes the organizations sacrifice for,
Okay, okay. So whatever you're saying is that there is some, intangible benefit,
correct.
right? For example, let me make it easier for you. For example, your organization is doing a charity project which is not bringing anything to the organization, which is not adding any value to the organizational uh, tangibly. Rather, it is spending your funds. You're spending your funds in charity project, right? So, although this may be aligned with the strategy of the organization, but this is not bringing any benefit, direct benefit to the organization. There is no addition to the business value. Maybe there is a little reduction to the business value, right? uh, you can, as a project manager, you can raise a question to the management that although this project is strategically aligned, this is a correct project, we should be doing it, but at the same time, we have observed that there is no business value being generated from this project. Can you please give me a reason why should we continue doing this? Are you all right with no value addition through this project? So you will get an answer from the management, from the strategic planning people that, okay, apparently it seems that we are not earning anything out of it, but this is a legal requirement that all businesses has to spend a specific percentage of amount in charity projects, and that's what we are doing. And if we don't do that, our business may be closed down by the government, right? So this is kind of a non-profit initiative we are undertaking, and actually that will earn us a good name, and intangibly we may be getting more business from government and other departments who understand our organization to be a charitable organization. So there are intangible benefits which will definitely add value to the business. So I have provided you a reason why should we do a project which is apparently not adding any value to the organization. So there might be some intangible benefit, there might be some reason behind it. And if that is provided, it becomes feasible. It becomes all right to go on with this project. So probably, Kelvin, what you meant by that, by saying the repetition thing, you probably meant something like that.
That's something that I have seen in the past. Another
Mhm.
thing is that like there are some small projects that you know um, we were requested to do. I mean, aside of the main contract, and at the end, by executing those kind of small projects,
Mhm.
uh, you know, zero profit from them. The
Mhm.
benefit that the organization got from making those kind of small project, caritative projects,
Okay.
was getting some favors in terms of tax payments and all this.
Okay. So that is the benefit. So
Exactly, it's
that
a
is a
benefit,
hidden
but
benefit.
it's indirect benefit. Yeah,
Yeah. So that is an indirect benefit. There's an intangible, maybe the intangible
yeah,
benefit. So if
yeah.
you find a reason that would add up to the value, that will be considered a business value. But what if there is something which is giving you no tangible value, no intangible value, and it is actually not raising the status of your business in any way at all? I would say any project which is not adding any value to the organizational worth, that should not be done. But before this making that decision, you should check with your strategic management as if they can provide you some reason for intangibility. If they allow you to go on without earning any profits, well, that there could be a reason. There could be an intangible reason. There could be intangible benefits coming out of it which you do not realize as a project manager, right?
Yeah, yeah.
So yes, please. Okay, Fatma, are you with me on it?
Yes, sure. Now I fully understand that part.
Exactly. But if you are sure that there is absolutely no tangible or intangible addition to the business value, then probably this is a moment to think over it. Why are we doing such an initiative for which we have no reason, for which there is no intangible or tangible benefit, and we are doing that job for last 2 years, and ultimately we are not supposed to generate any kind of value at all for the organization. Okay? So we should question that. We should always question that. And rather, I would say we should not do anything which is not adding any value to the organization. And when I say any value, that does include the tangible financial value as well as the intangible value, like the name of the organization, the sake, reputation of the organization, the brand of the organization, and things like that. So consider everything in the business value, and you will be able to do a kind of feasibility, a running feasibility throughout the life of the project. And when you find that project is no more profitable, is no more generating any value, you again could raise a question. And that could become a reason to close down that project. The people who are sitting in the portfolio management, who are deciding which projects and programs to be started and which are to be postponed or closed down, they may notice that and they can do it. They can do it, right? They can kill a project right in the middle if that is not generating any kind of value for the organization. Let me describe the same thing from yet another point of view. Let us forget about the project management. Let us talk about the organization. The current worth of your organization is $5 million. As a part of this organization, whatever you are doing in this organization, naturally people are getting paid for doing what they are doing. There are a lot of activity going on in the organization. I'm not only talking about the projects happening in the organization. Forget about the project right now. We are running a certain operations in the organization. Even in that scenario, do you think the value of the organization should increase in future or not? If you expect that after 2 or 5 years, the business value of the organization is not likely to change, then the expenditure you are doing in salaries and all the expenditure you are doing in the organization, and you are earning no value whatsoever, then probably this is again a question mark that do we expect the worth of the organization, of the business worth of the organization to remain the same after 2 years? Not at all. We want it to rise. Although I'm saying that you must include the intangibles in that as well. So, considering the tangible and intangible value, the worth of the organization in future is expected to arise. If it does not, then it's no matter whether we are doing projects or we are doing operations, whatever we are doing, everything must contribute some business value addition to the organization. Otherwise, again, it can raise a question, right? So naturally, if I look at from the financial point of view, if my organization is 5 million worth, then probably we are expecting it to rise by another 2 million or 1 million by the end of next 2 years, right? And if it does not happen, then there is a problem, right? Are you with me, Alexandra?
Yes.
So do you get the concept of business value?
Yes, absolutely.
It is just not, a arbitrary term that, okay, value addition is there. It is not just a dialogue. It is actually the increase in worth of the organization over time. And if there is no increase expected, then probably this business must be closed down. This is it's not bringing any profits to the organization, right? But you must ask the strategic management, what are their plans? Why the value of the business is not increasing? Why are we not able to contribute to the business worth of the organization? Why no addition to the business value is all right with them, they must have a reason for that, and they will provide you that reason. And if that is good enough, then we may say, okay, we can go on with it, right? But there is a question. Yes, you can always raise this question that is important. So every initiative you are taking in the organization, whether it is an operation or it is a project or program or portfolio, everything must contribute towards the business value of the organization. How do we do that? We do understand that when we do a project, there are certain benefits to be realized, maybe in long term. If this project is going to go on for 2 years, maybe the benefits will keep coming for another next 5 years after the project has been closed down, right? So that means the project has ended, but at the same time, we are reaping the benefits over time, right? So those are adding to the value of the organization. Those benefits we must count towards the benefit, towards the value addition to the business worth. So benefit realization is based on declared business value. So when we talk about benefit realization, when those benefits are to be realized, that would be the addition to the business value. And if a business is not increasing in its worth over time, that is not a good business at all. You don't expect that the worth of your organization, which is 5 million right now, after 10 or 20 years also, you expecting it to remain 5 million? Not at all. If that be the case, you should close down the business. You are not a good businessman at all. So you must be expecting that after 2 years, 5 years, 10 years, the worth is consistently going to increase, and that is what we are working for in whatever we are doing in the organization, whether we are running the operations of the organization, we are running challenges and initiatives for change like projects, programs, and portfolios. So I have highlighted the importance of business value and how does it relate to the benefit realization as far as projects are concerned. How do you examine the business value if you are asked to determine what is the current worth of your organization? How do you know that? I mean, maybe it is not your duty as a project manager, but at the strategic level, or for that matter, at the business analyst level, somebody should have been responsible for looking at the business value, examining and assessing the current business value of the organization, right? So you can always consult with that person, that business analyst, and see if the business worth of the organization or business value of the organization is consistently being increased. And moreover, what is your contribution? Your project is contributing how much value addition to the business value. This is your responsibility as a project manager, that my project has got this much, value addition to the business value. So for examining the business value, you have to communicate with stakeholders, do some kind of research, analysis, and use your expert knowledge. Examine, evaluate, and confirm to determine exactly what is or can be of value for the organization, right? And make a case that this value addition can bring organization to that higher level, more worth, and things like that. So specifically, what you could be looking for when you are trying to examine the business value, you could look at the shareholder value of, maybe only in case of publicly traded companies which have shares floated in the market. So is the value worth of the share increasing over time? That could be an indicator that the overall worth of the organization is consistently increasing, right? If you have dealt with the trading options, you might see that the worth of a share, which was initially maybe only $10, is increasing and currently it is $50, and it is likely to increase further. So that is an indication that organization business value is increasing over time. And for the private business, you could estimate the increase in business value by looking at the business growth. You could do a more keener analysis of how your business is growing, how your revenues are being generated, how much are you spending, are your revenues more than your spending, and how much more, and that could give you a very fair idea from the organizational point of view that your business worth or business value is increasing consistently. There could be some intangibles also, intangible value increases, like you are getting a good customer base over consistently for some time, although you may not have made a lot of profit right now, but there is a likelihood that this customer base is going to contribute to the addition, to the business value addition of the organization. Uh, when your employees do some good work, they gain some knowledge over time on job, whether they are working on projects or they're working on other activities within the organization. That knowledge is also an asset. Immediately, you may not realize that there is a value addition, but as your employees become more experienced, more knowledgeable, their way of working improves, and they can generate more value for the organization in lesser amount, right? You see, and a freshly inducted person can do a job with difficulty, maybe in 10 hours, but as he will gain experience, he would be able to do the same job in 5 hours, and maybe later on, when he is very experienced, he probably can do it in 2 hours. So you see, even if you increase the salary of this person over time, it is still profitable. It is still beneficial for the organization. This person is causing the overall business value of the organization to increase and enhance. And then channel our business partner value. So people who have become partners with your organization, just by getting those people on board, your business worth might have increased tangibly as well as intangibly. Maybe they have put in more money into your business, and that has increased the worth, or maybe just by getting a good business partner in your organization, you are likely to make some intangible or long-term profits in future. Those benefits could also be considered as business addition, business value addition. I hope I did make a case for that. How can we assess and examine the business value of your organization at any point in time? You can do it all the time, and specifically you should be concerned that how much addition is due to the contribution of my project. Kelvin, are you comfortable with the idea?
100%.
Does it strike to be true, and does it look like that you can do it?
Yeah.
Okay, good.
Definitely. When you do project management in general, you lose I mean, it's my personal experience.
Mm-hmm.
You lose the focus on this specific topic. So you just probably you check that business value at the very beginning of the project, but meanwhile you are executing the project, the contract, or whatever you have, you start losing visibility on that because you start developing another issues, another kind of problem, and you somehow don't come back to the roots, which is the reason why the project is being,
You see, that whatever is happening where you're, slowing down, or you're losing money, or you're making money, that is all happening within the project. Let us not look at those minor things, but let us talk about what is the overall impact of this project on the organization. Is it going to ultimately going to be of worth and value to the organization or not, right?
Yeah.
So don't get into the mechanics of the project management and what the project is, where you're slowing down and where you're, making more money, less money, or what. Let us talk about it in a nutshell. Is the project worth it? Should we continue doing it? Is it, are there any expectations that it is ultimately going to generate some kind of value and add that value to the organization? If there is no sign of any good future, then probably this project is not feasible anymore. So in that case, you should highlight this thing to the higher management and business analyst, and he should reanalyze the feasibility, and maybe portfolio manager may decide that this project is not worth it. We should close it down right here and rather put our money in onto a more profitable venture,
Yeah, how
right?
difficult will be that one? Facing you as a project manager, that situation that the project that you've been assigned to is
Mm-hmm.
no longer feasible, is no longer profitable. So you're gonna tell your, big boss or whoever is
Actually,
sponsoring the project, look,
actually,
this
it
project
is
is
not.
no longer happy. So you
You see,
basically are
I
hanging
understand.
out yourself.
It is not only the matter of you as a project manager realizing that this project is not generating any value, but a whole over the organization, the people sitting in the strategic management, the people sitting in the business analysis and business management, they are concerned about it and they are also making these kinds of estimates. And it is a joint decision, not a decision by the project manager. Project manager is just highlighting the issue, right? And
Yeah,
maybe the
that's what
strategic management convinces the project manager that please slow down. We are not making any profit right now, but ultimately this is going to be very beneficial. This is a very important customer. Even if we get a little loss here, this is kind of a marketing effort that we are going to 10 new projects from this same customer and we are going to make millions out of it. So don't worry about it. We know what is the issue. But as a project manager, it is your duty to highlight when you observe anything which looks like that it is going to be not feasible for the organization to continue. But naturally, the decision is further analysis and decision is with the business management people and the strategic management people, and they will ultimately decide. But you have done your duty. You have put up your, concerns to the organization that currently we don't think we are adding any value, and should we continue or should we not continue? This is not your decision to discontinue the project, right?
No, of course
But
not. But I mean, it's difficult. No, you to be the project manager, the one behind the wheel, steering wheel,
mhm. Exactly, exactly.
saying, you know what, I'm taking this car
Yeah.
to.
You see, let me give you an example. For example, your organization is involved in a very interesting project, which is naturally that is aligned with your strategy. We're very enthusiastic about it. We are making a lot of money out of it, but suddenly the organization is taken over by another organization. They bought your organization off, and when they bought off your organization, they come with their own strategy. So everything you were doing in this organization, according to the older strategy, is no more valid. So maybe the new organization which is taking over, their strategy is completely different, and the currently ongoing projects, which may have been very important for you,
Yeah,
are no more important for the new management, and they say close down all the project. What will you do in that situation? You will close down.
nothing. Yeah, yeah, it's a good example. Yeah, that's also happened when a company is
Exactly.
bought by another one. So the
Exactly.
new organization, the new management is coming, gun
Exactly.
blazing, gun blazing, checking all the,
Yeah.
losses on the project that are not that,
Exactly.
productive for the new
Similarly,
organization.
even if your organization is not been bought off, the strategy of your current organization has somehow changed, your orientation has changed. A lot many projects which were ongoing may be decided to be closed down. So, because you are a project manager and you are very much in love with what you do, your current project, you don't want to close it down, you don't like to talk about those things. But the people up there who are looking at the strategy, they may be very cynical. They may just kill a project at any point in time because they have assessed the whole situation that if we kill this project now, if we lose the business with this customer, is it still viable that we make money from elsewhere, which is much more, 10 times, 20 times more than what we are making here, and we can sacrifice this customer at maybe by paying some kind of penalty to the customer because we didn't complete their project, so you have to pay the penalty. But even after having paid the penalty and displeasing the customer, still if we are able to get other projects which are 20 30 times more profitable, more beneficial, why not? This is a strategic decision. Although a project manager may not like it, but the strategic management has other designs. So we have to step into the feet of those people, in the shoes of those people who are sitting up there, and highlight any such issues to them. Naturally, I'm not saying that you have the power as a project manager to close a project. None at all. You don't have that power. But your concerns about the business value, about the strategic alignment must be forwarded to the next higher level. The top level organization should, the strategic people and the business management people should know what is happening. And you are not the only one who is doing that. The portfolio manager is also looking at the same situation from his or her point of view. The program manager is also looking at from a higher pedestal. So all of them are submitting their suggestions to the organization, and ultimately this is a joint decision by the strategic management whether we should go on or not, if a project seems to be not bringing much of value. I hope this discussion is quite detailed and we have deliberated on all possibilities of strategic misalignment, hostile takeovers, change of strategy, business value not being generated on one cause or the other. So there could be a million reasons, but you are going to highlight whatever is true, whatever you think is right. Should I continue? When you are trying to assess the business value, you must understand, as I said, that business value could be tangible, it could be intangible. And if you want to classify the business value or the business worth, the business value could be generated in these 6 different areas. One is the financial gain, that is tangible, that is very much tangible. Another type is that you have started receiving new customers and a lot of new customers. So there is a likelihood that this is going to increase the business value in the long run. And ultimately, this is the intangible. Right now, you cannot translate it directly into financial terms, but you can have a guess that this stream of new customers, the people are getting more interested in our business and they are trying to buy our products more often. We have established our brand or something like that, and people are streaming towards us. That would be a good reason for business value increase. Then, like the charity project example I gave you, you are giving out some kind of social benefit to the society, and this should be part of your organization. And not only this might be regulated by the government that you should do some charity project or social benefit project, but at the same time you yourself know that if you do you show such compassion, your customers would be more obliged to work with you. People like charity, people like social work. So if you are spending a part of your revenues into social projects, that is going to earn you a good name. That is going to get you in the good books of the authorities, and ultimately you are. This is also an intangible benefit. You might be benefited in a long term. You will be able to generate better value. So consider that also added to your business value. Then there is yet another thing, and that is your initiative. How soon do you take an initiative? If you are first to market a specific project which is not being, floated by any of the competitors as yet, you are the very first person to create that product and market it in. You will collect the lion's share out of it. When the others will start producing it, then you won't have that opportunity of getting all the revenues related to that product which you are first to market. If other people start doing it, an intelligent businessman does have a strategy that they are always first to market their product, and as soon as other get into the market, they move on to another product, right? So they are always working on something which they will be first to market, and that could add a lot of value to the organizational business value, a lot of value. You see, this is a kind of a booster for an organization. It can multiply its business value by many times by doing this kind of initiative. So this is a direct benefit. It is not intangible. This is a tangible benefit. Then the fifth category is improvement. That is that whatever you are doing in your organization, whatever technological or other kinds of processes you are having, you keep working on improving and enhancing them and making them more efficient. If you make them more efficient, maybe 10%, 20%, 50% business value increase might result from internal tweaking of the system. And that could be your project, that you are trying to improve an internal process or technological process by which the operations of the organization are being conducted right now. But if you enhance and improve that, make it more efficient, then your revenues will definitely increase in that area. You increase your productive capacity. Previously, you were creating 100 units a day, and now you are capable of producing 500 units a day. So you can imagine your revenues will increase by 5 times, right? So this is very much tangible. Last but not the least is regularization. People like the clients like that you are kind of official, you are complying with the international standards of quality, of environment, of safety. By getting those regularizations, by getting those certifications, by getting those employment alignment with those compliances officially certified, you will gain more confidence of your customer, and customer will be comfortable working with you. So anything you spend in regularization effort would be an investment into the future. So if you can assure the compliance, the alignment with those specific standards, you might get more clients and more confidence of the client. And ultimately, all of these things will add up to your business value. Is that all right with you? Okay. Okay, let's move on to the part of business analysis, and specifically for you, Alexandra, in your CAPM syllabus, there is a little bit of talk about a specific part is about business analysis. Although we are not discussing a lot about business analysis, but you see, this is the job which is done by the business analyst who is creating the feasibility for the project, who is creating the business case. And when he has done that job and that business case has been created and approved by the top level management, that is when the project manager comes into play. Project manager is born after the approval of a business case. Project sponsor would be assigned the responsibility of selecting a project manager, writing a charter and giving that charter, which is a kind of a order to start the project, right? So that authorization is given to the project manager, and only then the project manager starts working on the project. That means everything which was happening about the project before this moment was all pre-project activity, and that was mostly under the responsibility of a business analyst who was creating the business case. First, he realized he realized a specific need aligned with the strategic objectives of the organization. Then he worked on it. He collected some data. He did some kind of analysis. He created a feasibility study. He developed a business case, which is kind of proving that this is a good initiative and this need assessment is proven to yield better value and results to the organization. It is aligned with the organizational strategy. This actually talks about the strategic alignment as well as the business value. This is all included in the business case. What is expected by the business analyst, that this is going to increase the business value, this is going to be aligned with our current strategy, and therefore it should be approved. So this is a big responsibility. And PMI, because PMI understand that the profession of project manager and business analyst, they are two different professions, but they coincide with each other. Because when the business analyst has created that case, that business case, and gotten it approved, after that the project manager gets into the play. Then project manager takes on the responsibility until the product of the project is delivered to the customer and project closes down. But remember, even after the project closes down, the responsibility of business analyst continues on until the benefits are realized in long run, right? So business analyst has a longer life. He starts working on the work of the project much before the project has started, and he continues monitoring the benefits long after the project has finished, right? So there is an overlap between the responsibilities of business analyst and a project manager. And if both of them are existing, when the project is going on, business analyst is also looking after the business interest of that project, because he is the person who developed the business case for this project, right? And once this project has been delivered, he would be responsible for ensuring that the benefits expected do get realized. I'm not saying that business analyst is responsible for realizing the benefits. Naturally, whomsoever is taking the product of the project into operations after the project ended, they are the people who are going to yield the benefits. They are actually going to be responsible for realizing those benefits. But the business analyst will always watch over their shoulder to ensure that the required benefits do get realized over time. I hope you are with me on that. Okay, I must say that the role, as I said, role of business analyst and the project manager may coincide at some points, specifically when a project is going on. What is the interest of business analyst, and what is the interest of project manager from the project point of view? Any ideas? What is a business analyst more interested when a project is going on, and what a project manager is more interested when project is going on? What are the specific interests of the business analyst and the project manager? Give me a difference. Fatma? Naturally, the business analyst would look at the big picture. Project manager may not be able to look at that big a picture because a project manager has a limited scope. So what project manager is focused on? Project manager is focused on doing the work. Doing the work. the scope of the project is the interest of the project manager. And the product owner who actually conceived the business case is more concerned about the product of the project. So product scope is kind of more of a responsibility of business analyst. In case there is a business analyst in your organization watching over the shoulder. So that in that case, if both people are available, the business analyst will take on the responsibility of product scope, and project manager will take on the responsibility of project scope. So if both are existing, then they can coordinate amongst themselves and they can share this responsibility. But if there is no business analyst in your organization, then probably project manager has to look after both of these areas, product scope and the project scope, because they are tied up with each other. Whatever is the product scope, project scope should be in alignment with the product scope. All the work we are doing in the project must yield those product benefits. Product scope must be completed as a result of doing the work of the project. I hope you understand my point. And because this situation is very common, that we may not have a separate person as a business analyst and a separate person as a project manager, it is usually seen that the same person who is the business analyst take on the responsibilities of project manager, and once the project is completed, he again gets back to his seat as a business analyst, right? So kind of I'm saying that business analyst might be having a dual responsibility. He can switch the hats and become a business analyst at one time and then become a project manager at another time. This could be one scenario. Second scenario could be there is no business analyst officially in your organization. When there was a business need in the organization, they hired you as a project manager and asked you to do the business analyst work. So all the pre-project activities were also done by you under the title of project manager, where there was no project existing as yet. You were trying to do the feasibility of it. So organization is paying you for that. So in a way, I would say you were doing the business analyst work during that time. And once the business case was approved and formally you were declared a project manager, that's when you assume the responsibilities of project manager. And again, when you hand over the product of your project to the operations or the customer, that is the point when you again switch your hats to the business analyst and you start monitoring how well they are delivering the benefits, right? Until your interests about the product scope are fully accomplished, all the benefits are completely realized. So yes, of course, I do understand and I do agree that these two roles of a business analyst and project manager could be working in parallel. They could be two separate people, or a business analyst could be the project manager, or project manager could be the business analyst, and switching hats. All these scenarios do exist in various organizations. So you have to understand, but I must specify that business analyst role is different than the project manager role. If you have to switch hats, then you must understand both of these things. And probably, Alexandra, that is why PMI wants you to know about business analysis in your CAPM exam. A couple of questions in your exam, CAPM exam, would be related to business analysis as well. For PMP students, yes, of course, you also need to know business analysis, the concept you should be very clear about, and a couple of questions maybe in the exam, but emphasis for a PMP is not a lot on business analysis. You need to understand what is the role of a business analyst and how does it coincide with a project manager. Anyways, for all practical purposes, PMI has got a separate certification for business analysis, and that is by PMI. That is called PBA, Practitioner in Business Analyst. analysis. So the standard for that is this book, which is called the Business Analysis for Practitioners, A Practice Guide. This is currently in second edition. And I must tell you, there is yet another book, which is the standard, that is called PMI Guide to Business Analysis. Now, this is just like a PMBOK. Like we have PMBOK, Project Management Body of Knowledge Guide, that is only for the project managers. For business analysts, they have got PMI Guide to Business Analysis. That is the standard for business analysis created by PMI. So those are the things you need to refer to. Those concepts you must understand to answer the business and analysis related question. Now let's look at what is there in this slide. Need assessment, collection of data, whose responsibility is this? Generally speaking, we say project manager is responsible for collecting the data, project manager is responsible for, doing things like that, But originally, when the idea of the project, the need of this project was realized by someone, at that time, project manager was nowhere to be seen. He was not even born at that point in time. That point in time, business analyst was working on it. So naturally, business analyst, when he was trying to create a business case or a feasibility of that thing, might have questioned a lot many stakeholders, might have gathered some data about what to do and what not to do in this project, what are the expectations of various stakeholders, how the things may be done, is it really feasible to do it or not, and which approach might be more suitable. All these questions might have come to the business analyst, and he might have done all these things in a specific level of detail. It may not be very detailed because he has just to prove that this can be done and should be done. Whereas project manager has to do it, so he has to dive deeper into those things and be very specific about the work of the project. Business analyst has done a little spade work, has created a little kind of a outline schedule and maybe a broad plan how this can be done and why is it feasible. You as a project manager, ultimately when you are on board, you are taking a cue from this work. So essentially, a business analyst is talking to the stakeholders. He has identified a number of stakeholders. He is doing the requirement collection. He is doing the requirement discussions, analysis, and all. This job has been done, but naturally not at a very detailed level. But once the project has been, the business case has been approved and project is formally chartered, project manager takes on the responsibility. Project manager then explores further deeper into the things as if he can plan the thing in the required level of detail, as now he is supposed to do the work, not just give out whether it is feasible or not, right? So project manager has been assigned this job. It is a reality now, and project manager has to do it. But naturally, I am saying a lot many things which the business analyst has already done. Project manager is going to elaborate more on them. So collect requirements, though it was done by the business analyst, the project manager also does it. And if the business analyst also exists in parallel to project manager, I would say the requirement analysis and requirement gathering responsibility can still be kept done by the business analyst. But naturally, I said that it might be possible you are the only one, you as a project manager may be performing the business analysis duties. So probably then you will look after the product scope as well as the project scope. So this all this activity of business analyst precedes, it all happens before the charter where the business case is approved, and they are responsible for creating the business case. Rather, I would say they will start with realizing a need for a business, and then that need is to be business need has to be translated into a business case through a feasibility study. It involves understanding of business goals and objectives and issues and opportunities. That I'm talking from the perspective of the business analyst. Even the business analyst is also ensuring that the business goals and objectives are clear to him. He knows the issues and opportunities. And considering all of this, he is trying to develop this case, right? So he recommends certain proposals to address what should be done, what should be the constraints, what should be the assumptions, what should be the risks and dependencies. But these are very arbitrary. This is not very detailed discussion, but just for the sake of proving the feasibility, this a little bit of detail has been worked out by the business analyst, and it will be moved to the project manager. When the project manager comes on board, he can explore further into the ground. So what could be the success measures for this business case? What could be the implementation approach? This all could have been suggested by the business analyst while he is doing his job. He is creating the business case. And once the business case is approved and project manager is assigned, then he will take over from that point onwards. So naturally, you may have to refer to this book if you really want to learn more things about it. That's it. So the questions here about this section: often before a project starts, business analysts or engineers conduct a need assessment for project approval and funding, right? Which two of the following are items identified or specified in a needs assessment for a new project? So these are four options, and I just have shown you a slide. Do we have the name of the project manager at that point in time? No. Business goals and objectives, are they considered? Yes. Potential constraints, assumptions, risk and dependencies? Yes. And individual or department who will handle the procurement invoices? That is unnecessary. Project has yet not started. So the correct answer would be B and C. What could be the business documents? Like, we have got project documents. Do you remember I did talk about the project document? Project management plan and project documents, there are two separate things. Project management plan includes all the management plans and the baselines, whereas the project documents include what? All other documents, like we have created a list or a register, and we have what all are the interim documents which are created during the planning. They are housed in the project documents. Similarly, the project manager, as he has project documents and project management plan, business analyst had created certain business documents, and there are, classically speaking, only two types of document. One document is called a business case. The other document is called a benefits management plan. Because the business analyst is looking at a long reach, in long term, what ultimately is going to be the benefit. It should be mentioned in your business case. What is the benefit and how long it will take to realize, right? So he will provide a business benefit management plan, how these benefits and when these benefits are expected to realize. Moreover, the business case, as you understand, that is the other document, which gives the feasibility, which makes a case whether this project should be done or should not be done. It is a case for the approval of the case of the prospective project. So business documents are developed prior to the project start by the business analyst or key project stakeholders. It contains information about project objectives and contribution to the business goals, helps the business to determine whether a project is worth required investment of time, money, and resources, meaning, is it feasible? And the business documents, as I just suggested, there are only two business documents. One is called the business case, which gets the approval, and benefit management plan will come into play when the benefits of this project will start realizing. Then we will plan around how and when these benefits are supposed to be realized. Although all the benefits may not be under the responsibility of the project manager, but he must consider that he should design the project in such a manner that it must be capable of delivering all those benefits in long run. So business case justifies the project and establishes the boundaries. Cost benefit analysis is done, business need is determined, quality specifications may be described, schedule and cost constraints could be described, although we may not have a complete schedule or a full plan for doing the project, but an outline kind of a plan could be there. They could have considered certain things, they could have come up with certain approximate timelines or dates when certain things could have been done. So this is basically the acceptance of the business case, which usually leads to the creation of the project charter, and that creation is done by the project sponsor. After the business case is approved, a project sponsor is nominated, who is actually the boss of the project manager, and this guy writes the order, the authorization to start the project, and gives it to the project manager. From there on, project manager is responsible for the work of the project. Coming back to the business analyst, while he's creating the business case, he also creates another document which is called the benefit management plan. The benefits expected out of this project, how, when, and where they are going to be realized. And as I am repeating it time and again, all the benefits of the project may not realize during the life of the project. When the project is being done, the benefits, a little bit of benefit might be realized, that we call the outcomes of the project, but long-term benefits may be realized many years after the end of the project. So project manager may not be held responsible for waiting for those benefits to realize. Project manager will hand over the output and outcome of the project to the body who is taking it over, who is taking the charge of the product, and then the realization of the benefit management plan would be under the responsibility of that those people who have taken it over. And who will oversee this, whether the benefits are being realized or not? The business analyst. Business analyst will oversee the realization of the benefit management plan. Do you agree with me? So that is about the business analysis part of it. And naturally, I hope, Alexandra, you have also learned something about it. You will be having a couple of questions on that as well. And same is true for PMP, but naturally, PMP questions are going to be a little bit more tricky, right? So whatever I have taught you here, that might be sufficient for you to answer these questions, as well as for Alexandra, although she didn't need to know things to such a deeper detail. But anyways, this is sufficient for you to pass the CAPM exam. Okay, what are the benefit measurement methods? Again, talking from the business analyst point of view. But you see, benefit measurement can be done by anyone. While the benefits are being realized, this could be done by the customer who is taking over, or while you are doing the project manager can do these kinds of analysis to ensure that all the benefits expected may be able to be realized ultimately or not. So, generally speaking, you must be aware about the concept, because this is not only the benefit measurement method. This could be used anywhere. These are just the tools. Cost benefit analysis, payback period. They are just tools. Like, we have got net profit, we have got net present value, we have got internal rate of return, we have got return on investment. They are all different methods which are used for analysis purposes, although they may be required for business analysis purposes, they may be required for benefit measurement purposes, but at the same time, they can be used anywhere. They can be used during the project, they can be used after the project, they can be used anywhere. These are just a couple of tools, right? So what is cost benefit analysis? Let's not talk about the project or the business analyst responsibilities. Cost benefit analysis is a universal concept. Any initiative you are getting into, how much investment does that require, and how much benefits will that yield, right? If I am starting a new business, I am investing, say, $100,000 in that business. That is my initial cost. Why I am investing $100,000 in that business? Because I am expecting benefits from that business way beyond this amount, right? Agreed or not? If the benefits are not even equal to our investment, then what is the fun of starting this new business? Are you going to waste your money? Not at all. We don't want to do that. We don't want to waste the money. So cost benefit analysis, our purpose is that our benefits should be more than the cost. So this could be a very important tool if you do the cost benefit analysis and it will prove that benefits are more than the cost. That makes a case for business. That makes it feasible. Yes, of course. If the benefits are more than the investment, then this is good. This is good. This is going to give some benefits ultimately. But then the question is, which feasibility, maybe there are 10 different feasibilities, which feasibility is the best feasibility? What do you say? If there are 10 feasible projects in front of you and you have funds to allocate to only one project at one point in time, then which project will you start? What should be the characteristic of that one project?
The project with more benefits or value?
The most value, the project which is, although all 10 projects are feasible, but the one which is bringing us the maximum benefit, or if you want to be more specific, the benefit cost ratio is higher. The highest benefit cost ratio will be chosen. Then yet
Yes, risk and the return of investment. I mean, the quicker we get that.
Say again.
I would say the one that represent the less risk and where you get the return of your investment quicker.
Okay. Naturally, there are risks associated with anything you do in your project, and when we are doing the cost benefit analysis, we are making a lot of assumptions, right? This is going to happen in this way. We expect things to happen in a certain way. Now, these are our assumptions that if we'll go this way, this will happen. But there is a lot of risk in all of that because these assumptions which I have made in my business analysis might go wrong. That is where the risk can lurk into the project and can change the whole shape of the project. But still, when I'm doing the business analysis, I do a little bit of risk identification and risk management. But you see, nothing is on ground, so I can't be very definite, right? These risks are going to occur during the life of the project, and project manager might be the right person to address them as risks. It is very, very fine if the business analyst can indicate certain possibilities which are the risks which might occur during the life of the project, and project manager can take cue from there. But basically, it is in the domain of the project manager where those risks are likely to happen, and therefore he has got a larger responsibility of risk management. Business analyst can just try to identify some of the apparent risks which might occur in the project, but that does not really, no action is taken by this person because things have yet not started happening. Project has yet not been on ground, right? When the project is on ground, the responsibility of the project or day-to-day working of the project will fall on the shoulders of the project manager. And when he starts doing the things and the uncertainties start occurring, or the likelihood of certain risks increase. So that is where the project manager will come into action about risk management, right? That is a continuous work, but from the point of view of the business analyst, the risk management activities are kind of limited for the future, and project manager is dealing with all the uncertainties in his job description. Anyways, this cost benefit analysis thing, which I said that benefits should be always be more than cost, that means this is also gives us a formula for net profit. Net profit is equal to the total benefits coming out of this project, add up all the benefits, minus the total cost we have invested into this. So very simply, it could be said, it could be written down as net profit is equal to what? Total benefits plus
minus.
total cost, right? So this could be the formula for net profit, and this is the formula for feasibility also. So the person who is showing this project to be feasible, then total benefits coming out of that project should be way larger than the total investments or total cost spent on the project, which will be spent on the project. We are just assuming at this point in time, business analyst has not spent any money on the project actually, but he's assuming this is going to happen in future. So he projects into the future and tries to do some kind of cost benefit analysis. As a result, net profit is there, right? So are you okay with the concept of net profit? That is a basic most method when we are talking about the benefit measurement methods. So cost benefit analysis, this is the first tool. Are you comfortable with this net profit formula?
Back to your question, Suhail, what should be the variable that we need to consider to select a project out of,
Okay. It is not the job of the business analyst to select a project. He has to just put up the feasible projects to the strategic management. Business analyst job is done. He has created a case. He says, okay, this project is good, this project is good, this project. So these are 10 projects. They all are feasible. Now the strategic management have all the authority which projects to initiate, which not to initiate. Maybe all of them are 10 projects are feasible, but they decide not to start all 10 of them because they have limited funding. Although strategic management can make this decision, but if the projects, if this kind of activity is too much in an organization, they probably will need a portfolio manager to look into detail of these projects and do a little bit of analysis and decide accordingly or suggest accordingly to the strategic management which projects and which programs should be started. So portfolio manager is a new role. If at all this role is existing in your organization, probably this person is going to take on that responsibility of suggesting which projects are more likely to yield more benefit and which are recommended to be started. Ultimate decision of starting a project or a program still lies with the strategic management until and unless they delegate this authority to the portfolio manager. And that is very much possible. Portfolio manager may be delegated these authorities. Am I clear about
subject to the strategic management?
Yes, of course. Naturally, the decision makers are those sitting in the strategic management, the CEO and his members and all big players, key players. So they are the people who have to actually make the decision. But this portfolio manager, this business analyst, the program manager, project manager, they all are working under them. They can put up suggestions to them, but the decisions are going to be, the strategic decisions are going to be coming from top, right? So anyways, the business analyst is not responsible for choosing which project to start, but business analyst is going to present the business cases for all feasible projects. No, it is not. He cannot decide which project will actually be started, but all the feasible projects will be presented to the top level management, and then they decide which project to start and which not to start. Right? Okay. This is the net profit. There is another method here which is called payback period. Payback period is if I invest in a business, how much time will it take to pay me back the amount I have invested? Do you get me, Alexandra? I am starting a business. I make X amount of money as an investment into that project. If I put it in project business number one, it returns all my $100,000 in 2 years. Another project does that in 3 years. Another project does that. Another case does that in 1 year. So which is better? Better is shortest payback period, right? So this could be another way of analyzing which project is going to give me the payback earliest. So the shortest payback period, whichever project does have that, that could be preferred if this is the criteria. Now, why do we have this criteria? Why are we not looking at the net profit here? That is because maybe you have started a business, a new business, and it is all based on some kind of loan you have taken from a bank. And bank charges heavy fee, heavy interest on that loan, and you want to get rid of that loan as soon as possible because you know when you will pay that loan off, whether the business is very profitable or not, but you will own the business after that. Until and unless you pay that off to the bank, they have got stakes in the business, and they will control the business. And if you can't pay back to the bank, they can own your business. So what is your interest? If you have taken a loan and started a project, you want to pay off the loan as soon as possible, and that is through payback period. You will like to invest on a project which has got the shortest payback period. Maybe, the shortest payback period is 1 year. So I get the loan from the bank and they charge me 10% interest. I say, okay, I will be able to pay you back in 1 year. And after 1 year, I have no liabilities. This is all my investment. I have paid back the bank. And now it does not matter if this business is not making a lot of profit in the beginning, but still it has paid us off. Now we can sit back and relax, and we can run this business in long term. So this is only for that concern when you have to look at repayment of your loans are all. There are other methods which are even more interesting, like we have got the net present value, ROI, and internal rate of return. But there is yet a concept which you should know, although it doesn't really relate to the benefit measurement. But yes, of course, there is a comparison normally to be made. That is called an opportunity cost. Do you have any idea what is the opportunity cost, Fatma?
Mm, the opportunity cost,
Mm-hmm.
the profit,
Profit. Okay, that is one idea. Alexandra, what do you think? What is an opportunity cost?
The way that I understand it is that it's you can invest your time in something, you can invest resources in something. Um, and like what if and they'll have a return and what if you invested your resources in something else? So it's like which is going to provide like which different opportunity is going to provide the most benefit.
Exactly.
It's like kind of the sense of like there's no such thing as a free lunch where like you're investing your time in that free lunch, but
Okay.
like you're like there's different, yeah, I'm not explaining myself well.
Okay, in a way you are right, but you see, opportunity cost okay. Let me talk. Let me ask Calvin. What does he understand? Yes, Calvin.
No idea.
That is the best answer.
It's very ambiguous. I don't know. I
Okay.
can get lost like Alexandra.
Okay, no problem, no problem. Alexandra is closest to the answer, but you see, if you have got five different options to choose from, naturally you will go for the best option. Agree with me? For example, there were five different projects, and you had to pick the best. So you picked X project. But the second best project could have been chosen if this first project was not there, right? So whatever is the cost of the second best option is considered the opportunity cost. And whenever you have a problem in your chosen cost, chosen project, chosen way of working, you will always say that my opportunity cost was this much. You will quote the cost of the second best option as an opportunity cost. Like Alexander said, if I did not do this project and rather I did not do this business and put this money in the bank, I would have earned more from that business. That is like, referring to the opportunity cost. So if I could have put my money in the bank, that was an opportunity cost, but that was the second best option. The first option was I start my own business, but my business is not giving me that much profit. So I start considering what was my second option. And if I would have gone for that, I would have been profited. And this is the benefit
Can this
of
be
cost.
related to the process of, when, especially if you are, contracting some works and you go for a tender process and you
Mhm.
receive several tenders.
Yeah,
So
yeah,
let's
yeah.
say that you select the first one, which is most of the
Exactly.
time is selected by the less cost,
Yes.
you know. So we can consider the opportunity cost
Opportunity cost. The
what we can
second,
say with the second one, the
the
second
second
option.
one. Yes, exactly. Exactly. That you
Okay.
understood very well. Now, you may have questions in the exam related to opportunity cost, but
Generally, what's
remember,
happening is that the second option at the
yes,
end is sometimes the best one because the cheap,
yep,
always bring some issues during the,
exactly.
the course at the end, all the opportunity cost is exceeded
Yes.
by the extra cost that
No,
you get from the main
yes,
contractor.
yes. Normally, there is a tie between the first and second. They are very close to each other. And
Yeah,
second might be even more beneficial, maybe
yeah.
if that has been chosen. That is exactly why we call it an opportunity cost.
Okay.
But this
Can
cost is not to be calculated in any calculations. It is not supposed to be, you can't show it in your cost, you can't show it in your anything. It is just a referral you are making that if we would have done it that way, this could be our opportunity cost, right? So that is just
I like
a
the
referral.
name. I like the name.
Yeah, exactly, exactly. Okay, then there is another method. I have to go to the last one, which is return on investment. Return on investment looks like a very fancy term, and people, say that in most of their presentations, and they are very impressive in talking about ROI, return on investment. But let me tell you, return on investment is not a very complicated science. It is a very rudimentary tool. I don't like this tool at all because this is not accurate at all. Like the net profit is absolutely not accurate. Net profit is just an assumption, just a broad calculation. And trust me, return on investment is a little better than net profit because it is based on the same calculation of the net profit. The only problem is net profit just gives you a figure, a plus or a minus figure, which could be representative of whether it is feasible or not. That's the sole purpose of net profit. Now, in return on investment, we do a further calculation in it to make it a bit more sane. What we do is we say, okay, what is the net profit of the of this project. Say this project is go on for 5 years, and in 5 years, the net result or the net profit would be, say, $500,000. So if the net profit is $500,000 in 5 years, what is the average annual profit? Now, whatever was the inaccuracy in the system of net profit, we are working based on that. And so our ROI method will be as inaccurate, although it may look like, the figures may be more attractive to see. So what is going to be your profit per year? What is the per year profit? Again, let me give you the figures. Net profit is 5 years. Net profit is $500,000, and the duration of the project is 5 years.
Mhm.
What is the average annual profit?
100,000.
Exactly. So you simply divide the net profit with the 5 years, with the duration, and you get, okay, in 100,000. Okay, how much have you invested in this project? Right? So that investment is also necessary to note. For example, you invested, say, 10, you invested, these five are going to come. Maybe you invested $200,000 in this project, right? By investing $200,000, you are expected to get back, on average, $100,000 per year. What is your yearly profit?
40 something percent.
But there is a total investment is $200,000, right?
Mhm.
And every year you are getting an average benefit of $100,000. Naturally, you will be having 500,000 in 5 years, but if I calculate it from the average annual profit, what is the return on investment? That is a percent. What is the percentage of
60K?
investment? Yes?
60K a month? A year? Sorry.
Yes, the average yearly profit is 100,000. Total investment is
100,000?
200,000. So what is 100,000 as compared to 200,000? That is the average
If
annual profit. This is
it's
50%.
50%.
That is 50%. So 50% is my ROI. But remember, this figure is normally confused with the interest rate or something like that. Trust me, this is not interest rate at all. This is a simple average taken against the investment and the yearly annual profit, right? So simply, how can you write that down? Let me try to, where should I do it? Okay, let's do it here. So what I'm saying is ROI should be equal to what?
Net benefit.
Yearly annual profit
Divided by total cost.
multiplied by, I'm sorry, let me make it bigger. Let us put a arrest, sorry. Okay. Yearly annual profit multiplied by what?
100.
By
100.
100. Okay.
And then divided by
Divided by the
total cost.
investment, right?
Total investment, everything.
Okay. Multiplied by 100 and divided by investment. Right? Does it make the sense? Yeah. This is your ROI. So what is so special about ROI? I don't understand why people speak it, that is like a slang. The ROI of this project is too high. What does that really mean? ROI
The
is
project,
nothing, is nothing. It's just an
Mhm.
indicator.
Yeah.
We should rather be looking at the other methods like NPV and IRR, which are more interesting and more reasonable. Net profit is approximation, ROI is approximation of approximation, and payback period is making a little sense when you have taken money for the loan. But you see, ROI is nothing really very special, nothing really very special at all, right? But anyways, as a business analyst, you may have to use these inaccurate things a lot. You have to refer to the net profit, ROI. So, from the business analyst point of view, I would say, okay, but from the project manager point of view, I don't think ROI and net profit is any good for you. You should be rather talking about the net present value and the IRR. Anyways, to cut the long story short, let us move on to more, accurate methods, and that is NPV, net present value, and that works on time value of money. Now, I want your undivided attention on this. If you don't know this, you might need to learn what it is. Okay, just try to grasp the idea. Let me calculate forward first. Calculate forward means, for example, you have $100,000 with you and you want to put it in the bank. Bank is paying you a specific interest rate. Say they are giving you an interest rate of 10%. What is the future value of this money, of this present money, after 1 year? Anyone?
110,000.
110,000. Okay. On compounded interest basis, because you are not withdrawing these 10,000 profit from the bank, it is still lying in the bank, and this is a compound interest account you have taken loan out of. So tell me, what would be the future value of this money, $100,000, after 2 years?
After 2 years?
How much? After 2 years.
After 2 years?
Two.
Okay.
121,000.
Very good. How do you do that? You have from the 100,000, the basic 100,000, you have another 10,000 coming, but the profit of the previous year was not just 10,000, it was 11,000. So the 1,000 further yielded, the 10,000 which you earned last year, that the 1% of that is 1,000, which is added to it. So 1,000, 20,000 for the first year, 20,000 for the next year, and the interest on the first year is 1,000. So 1 plus 10 plus 10 plus 1 is 121,000. So let me know what is the future value of third year. Mm-hmm.
It's
One,
262
total
500.
future value
Sorry?
of the third year. Okay, how much? One?
It's 30% or 30th.
Okay, no, give me the
It would be
amount. What is the
133,100.
exactly?
No, 250, yeah.
133,100.
Yeah.
133,100. So whatever is in your bank, that was 121, you put an interest of 10% on 121, and that would actually yield in the answer 133,100. But as you move ahead in the fourth year and fifth year and sixth year, this calculation starts becoming complicated, right? So you should have a formula to calculate that. Do you know that formula? Anyone?
Yes, I know.
Okay. Let me tell you, if we are moving forward from present to future, the future value of the money is equal to
What's
the
your present
present
value?
value. Ji?
Yeah, present value multiplied by
Yeah,
1
exactly,
plus.
exactly.
Yeah,
Present
yeah.
value multiplied by
1 plus or yeah,
1 plus interest rate, because we are moving
yeah,
forward. So we have got interest rate raised uh, raised to the power number of years.
of years.
How
Yeah,
do I write? Raised to the power number of years. Got it? This
yeah.
is the formula. Now let's put, say, 100,000 is your investment. Put PV as 100,000 and I as 10%. And if it is 3 years, then put 3 times on it. So if I is 10%, that means 10 by 100. 1 plus 10 by 100 is 1.1. 1 plus 10 by 100 is 1.1. Agree or not? Okay, let me write it down here. I say PV, PV which is 100,000 multiplied by 1 plus 10%
10%. Yeah,
raised to the power 3 years. So
3
raised to the power
years.
3, right? So what will it become? It will become is equal to
13200.
100,000 multiplied by 1 plus 10 by 100 raised to the power 3. Is it okay? And I can also write that like, 100,000 multiplied by 1.1 raised to the power 3. Are you okay with it? I can write it like that. So that will give me the future value. Rather than, calculating 100, 110, 121, 133, 100 and things like that, you can straight away do that, and you can do that for maybe the 50th year also. Raised to the power 50, it will give you the value directly of the 50th year. So this is a formula for doing that. But this is just an example, because in projects, the things are happening into the future and we are making the investment now, right? Right? So if I make a certain investment now, what will be the future value of the money that I need to calculate? We have expectations of certain future values generated in the future, and I want to convert those values in today's money worth, as if I can compare it with my investment. I hope you understand my point. So, in a way, let me write the formula for present value. If you you are likely to earn $100,000 after a year. What is the present worth of that $100,000? Right? So the present value is equal to future value. But if you are a little bit good in maths, present value is equal to future value. Here PV, this thing is multiplied by PV, and if I move whole of this thing on the other side, it will be divided by PV. You agree? Divided by
Yeah,
SP. So okay, 1 plus, but there is the trick to it. Trick is that when you are dealing with future, when we are trying to go towards the future, you use the percentage which is called interest rate. But if you are calculating backwards, there is a different percentage which is called discount rate. There are two separate different types of percentages issued by the whatever is the national bank. In every country, they could have a different figure. Let us call it R, right? And it is again raised to the power number of years. Rest everything is same. Okay, so let us calculate if I am supposed to be getting $100,000 after 1 year, then what is it currently worth? So what I need to do is divide it by, sorry, let us assume it is again 10%, although it will not be always 10%, it would be less than that. Yeah. So let us say it is 1 divided by 1.1 raised to the power 3. If you can be kind enough to try to calculate this, you will be amazed by the answer because that is not what you are expecting. What is the answer of that? And how does it make sense? The money which is expected to be coming to you after 1 year is $100,000. And applying the discount rate of 10%, what is the current worth of that money? So I am dividing 100,000 by 1.1 raised to the power 3. That comes out to be,
75,000.
yeah, 90?
75,131.
Right. So the money is going to reduce, right? Money is going to reduce. Here, there, the money was increasing in the future value. The future money is going to be less in present terms, right? So when we calculated the net profit, we didn't bother about that. The money which is coming in first year or second year or third year, we did not bother to calculate the time value of money. And NPV is a method in which we do that. And that is an excellent method because at least it respects some kind of rule of the bank. When they give loan to you, they apply interest on you, right? And when you put your money in the bank is taking loan from you, they will pay back interest to you. But when somebody takes loan from the bank, they apply discount rate on them. I mean to say that if your money is put in the bank and bank has to pay 10% to you every year for keeping that money, then when the bank will give the loan to someone else, they definitely want to earn more than that. So the discount rate will be higher, right? They will be charging maybe 12% from the other party, giving 10% to you and keeping 2% for the bank, management of the bank. I hope you understand my point. So that is exactly what the bank rate is all about, this interest rate and discount rate. Why are they different? They are different as if the bank can also earn from the movement of money. So if I know what I'm going to get at the end of first year, at the end of second year, and then end of third year, and if I can calculate the present values for every year and then sum it all up, that will be the net present value. But remember, the investment should be subtracted from it to get the net present value. Just like total benefits plus total cost. Similarly, we are saying that total net profit minus the current cost, total cost investment we have made. So that will give me the value of NPV, net present value, and you will be amazed that the value of NPV is going to be a lot different from the net profit value, a lot different. And this is more realistic. This is more accurate. This is nearest to the reality. So internal rate of return, this is how we calculate that. So PV of first year plus PV of second year plus PV of third year plus PV of fourth year, PV of fifth year minus the total investment made in the beginning. That is the formula for your NPV. Or I can write it like NPV is equal to PV of the PV of the first year, PV0 before that is the investment. So that will actually be shown as a negative sign plus PV1 plus PV2 plus PV3 plus PV4 plus PV5. So if you do that, if you do this formula, then you will get the value of net present value. Got it? Now this is interesting. We can see some examples also. But let me describe the best method. The return on investment is even better than IRR, because the problem with IRR is that is you are doing a business or a project which has nothing to do with taking a loan from the bank or something, but still you are trying to use the same banking figures like interest rate and discount rate, which might be good enough for comparing your business with the opportunity cost of investing in the bank. But if it is, but I do understand businesses make more money than the banks, right? So therefore, my business or my initiative should have more internal capacity. What is the internal rate of return of my project, disregarding the rate of the bank? Interest rate and discount rate, I'm not going to honor that any further. In the internal rate of return, although I'll be using the same formula as that of NPV, but without the discount rate. How is that? That is very strange. Okay, how I do it is I say if the NPV is 0, what does that mean? If your net present value is 0, that means the present value of all the money is coming in the future and all the money which I have spent right now, they are equal, right? So everything in future coming minus my current investment is equal to 0. That means this is a break-even point from the time value of money. Break-even point from the time value of money point of view. Agreed or not?
Yes, because you're not losing
Okay.
and you're not getting
Now
anything.
that we know NPV can be 0, NPV can be minus, NPV can be plus. If NPV is plus, it is good. If NPV is 0, it is kind of break even. And if NPV is less than 1, it is bad. Agreed? Okay. I say rather than using a percentage, the discount rate, let us find that percentage on which NPV of this business will become 0. That will give me the break-even point of that business. So I have to do some hit and trials. I say, okay, let's put, for example, let's take 2%. I say 2%, it is too much negative. Okay, 5%, still negative. 7%, still negative. 9%, okay, now we have a value which is kind of a little positive. So let us go a little down. I say 8.8%. So maybe, let us say, after this hit and trial, I found that if the discount rate of 8.8% could be applied, that would result in NPV equal to 0. Agree or not? So that percentage which I just found is actually not the discount rate. That is called IRR. That is internal rate of return. That is the percent on which the NPV becomes 0. And because every project will have a different NPV, different IRR. And if you have to compare amongst a couple of projects, the project with the highest IRR is the best project, is the best option. So basically, these are various methods for doing your business case, cost benefit analysis methods for doing your business case. So what method I have just taught you? Cost benefit, under the cost benefit analysis, we have got net profit, we have got what was
Opportunity cost.
payback period, ROI, and then we have IRR, we have ROI. Although we did discuss a little bit about the opportunity cost, but that is not a method. That is just a comparison. So this is all about it. You can look at the subsequent slides. There are some examples there. I don't want to go into those details because I've already given you a lot of examples here and we have actually covered it all. But I'll just show you the next couple of slides. So this is just kind of a calculation which he has made. The investment he is making in the beginning is $1,200. It is shown as negative because it is an investment, it is not a profit. And because it is today's money, so it will be the same amount is not multiplied or divided by anything. So it will be multiplied by 1, right? And it will remain this money. The money, $400, which is going to come after 1 year at the rate of 10%, it has to be divided by 0.9, sorry, it has to be divided by 1.1, or in another way, we can say it has to be multiplied by 0.91. 1 divided by 1.1 is equal to 0.91. So if I can multiply 400 with 0.91, or I can divide 400 by 1.1, I will get 364. Similarly, the money which is coming in the second year is 800. It is the present worth is $664. Money which is coming in third year, the present worth is $450. The money which is coming in last year, that is $1,200. That is present worth is 816. Now, if I can add all these positive figures and subtract 1,200 from them, whatever is the answer is my net present value. Agreed? Okay, which three of the following are financially based benefit measurement methods? Choose 3. Quickly.
Internal rate of return, return on investment, net present value.
Okay. So first 3 are correct. Opportunity cost is not a method. This is just a comparison or a concept. Question. Opportunity cost is defined as the value of a proposed project selected. Right or wrong?
It's wrong.
It's wrong. Do you all agree with her?
Yes, it's wrong.
Because it is not the value of the proposed project selected, but the second best option. Right? Okay, moving on. Which of the following is a financial tool that calculates the present value of all cash outflows minus the present value of all cash inflows? Very simple.
Net present value.
Yes, net present value is the right answer. And that's it. I will discuss OKRs from tomorrow. Just remind me, we are on slide number 53, right? So tomorrow we will start from here and I will discuss OKRs. Probably I mentioned OKRs earlier. Did I or did I not?
Yes,
So
you did.
let us
Yes.
start from here tomorrow. Any questions so far? Kevin, are you okay?
Yeah.
Okay. Thank you very much. I think we can call it a day. We can meet again tomorrow, same time, and we will talk more about things. If my talk is not getting very interesting, it's getting boring, please interact with me. Give me some jokes, give me something to talk and laugh about, and that would make it more fun. Thank you very much and take care. Take care.
Thank you so
Thank
much.
you.
See you.
You
Bye-bye.
see you. Bye.